Hi, my name is Colette Rabba, and I'm with Orion Realty. I'm a residential real estate broker in the GTA West, an income property specialist, and an investor myself. The reason why Araceli and I like to do this show is because we're both investors and we love to give great information to viewers and listeners just like you.
Welcome everyone. This is Araceli, wealth advisor, U.S. real estate investor, and Canada real estate investor as well, and creator of Wealthy Women and Real Estate. And in my weekly call with Colette today, we have a special guest. Colette, can you introduce yourself?
Of course. Hi everybody. My name is Colette Rabba, and I'm a residential real estate broker in the GTA. And also an investor, just in Canada, not in the US. I'm not as fancy as Araceli and Tim, but hopefully one day I will become one, and hopefully soon, because the borders should be opening up soon, and we can start going back and forth again. And actually, that's how I met Araceli and Tim, was through US investing. I'm sorry, my phone is ringing. I just want to say welcome, Tim. I'm happy. We're happy to have you on the show. We actually want Tim to come on and talk about something that he has gone through himself, and that is mortgage notes, which is something that normally people don't really hear about.
Because this is mostly done in the US, so that's why.
But it's good information to have. So welcome, Tim.
Absolutely. So Tim, can you tell us what a mortgage note is?
Well, if you're familiar with the financial crisis in 2008, right? There was and has been in the United States a secondary market in mortgages as securities for quite a long time. We don't do that in Canada. We don't do it the same way. The notion is that if you as a homeowner have a mortgage, the bank can take your mortgage and sell it to somebody.
Okay.
So your payments, instead of going to Bank of America as an example, they go to Chase Manhattan instead. And there's a secondary market who trades these mortgages in the past. And then I will say that during the Clinton administration, some of the rules changed and Wall Street started bundling many of them together and selling them as a mortgage-backed securities. Now, all of the machinations and things underneath that, I don't understand. But I do know that after 2008, many of the banks had non-performing mortgages on their books. These were the people who went through financial difficulty en masse and couldn't afford to keep their homes anymore, because in many cases the mortgages themselves the terms and conditions were ridiculously maybe consumer orientated, so that you could get an initial mortgage for 2 or 3 years at 3%, and then after that the interest rate would jump to 19%, just like a credit card. Things like that were going on, and I'm no expert.
There's no real regulation, because when as Canadians, let's just go back to how it is in Canada now. As a Canadian mortgage holder, I go to Bank ABC and say, here, please lend me X number of dollars, and I have blinders on, they have blinders on, my agreement is only with them, and they cannot take my mortgage and sell it to someone else.
That's right.
For whatever reason.
Yeah.
Okay.
Generally,
so that's what a note is.
That is how it works.
And that's what they call a note.
So how do you get involved with notes? How do you buy notes, Tim?
Well, what I found was at a networking meeting was a fellow who had a legal entity. It was in the US, and he would buy the US mortgage through this legal entity, and he dealt with a few of them, and there's actually trade shows you can go to and learn all about how to do this. And in one case I educated myself with a couple of courses, and then I went down to Las Vegas and I spent a 3 days at a conference and met a bunch of people and learned all about it, and this is an ongoing thing. So the scheme is that instead of investing directly in the house, in the property, you buy the paperwork that represents the mortgage, and then you track down the original owner of the house who had the mortgage and has defaulted, and you attempt to restructure it. So let's say they owe $100,000 on the mortgage at an interest rate of 10%, right? You can approach the person, and in order to clear their and improve their credit score, what you did was you perhaps paid $15,000 for that mortgage of your own money, and you're approaching the original person who had the name on the mortgage, and you're saying, I'll tell you what, for a 10% interest rate, we'll cut the amount you owe from 100 down to 55. So you can clean up and get this thing of this financial cloud over your head cleared up, and off you go. Now, the profitability in the whole thing is that you paid 15 or a lower amount than the 55, and you become like their bank.
Right, you're a private investor now.
Yeah. Now, there are companies who are out there who will sell these things to you, right?
Still?
Yeah.
Okay, and what's the security behind it like?
Well, you're buying a mortgage.
Okay, but your name is not going on title, or you have that security of being on title?
You own the mortgage. You own the paperwork. And in fact, I have one. It's in a file folder down in the basement. It's a thick file folder like that shows all the paperwork and all the payments that were made, right? And in one case, I made 19% in about 8 months. In another case, I made about 6% over a year.
And do you have a facilitator doing all the paperwork follow-up for you?
The way it worked out was I fronted the money, and I got half of the profits. And the other fella that I work with, he did all the work.
So it was sort of like a partnership. He does all the work to follow up with the homeowner to make the deal, to restructure it. And then Tim gets half of it because he put the money to buy the mortgage paperwork.
But there's no middle entity, let's say like a lawyer or a mortgage broker or someone who is facilitating that combination between you and the homeowner.
No, there's the only entity in between is called a mortgage servicer.
Okay.
Mortgage servicer is the person who actually chases the mortgage owner, the mortgage holder, for the payments.
Okay, so this is almost, I really don't want to say it's like a rent to own situation, but it's like more of a private lending. Call it. Instead of going to the bank, you have lent them the money.
So what would they, Tim, people are enticed to buy mortgage notes instead of buying directly the property or negotiating directly with it? What is the reason?
The sort of advantage, if you think of it, or the cool thing about it, is you don't actually own the property. So you're not responsible for taxes. You're not responsible for...
You're not a landlord.
Pardon me?
You're not a landlord.
You're not a landlord, right? You don't have to mow the lawn. You don't have to maintain the property. You just own the mortgage on the property, because the property has an inherent value regardless of the state of the economy in general, and that value is going up or down depending on the neighborhood and what's going on in the world at large. So the mortgage is kind of like this bit of paperwork. This mortgage represents a claim on the title of the house.
And I'm assuming in your paperwork, you are the first mortgage.
Yeah.
And
in some cases, the second mortgage.
Okay, but
you can do a second mortgage, but first mortgage is more common.
Right. And the other too is within your paperwork. If it were me, I would write in something like, you can't have a second mortgage on the property because if, things go south, we really need to clear, I need to get this money out.
Yeah.
And paid, the first mortgage is always the first one to be paid out first.
Yeah.
As far as I know, before any other creditors come knocking.
Right.
So that's why you look at your paperwork. I think that's ultimately the little tip here, is to make sure that as an investor, you want to make sure that it's written to your advantage, not to the mortgagee, really.
Yeah. Now,
that's not the only set of details to think of, right?
Yeah, there's other, but
so
ultimately, I want my money back. I want to make sure I'm safe.
That's the first thing to secure, right? Your money. But Tim, what can go wrong with it? Like, can you always be in the positive? Is there a chance to lose money?
Oh yeah.
Okay, so tell
Definitely.
us.
So, mortgage, if it's 2007, 2008, when the whole crisis happened, people lose their houses. Okay, so the house is sitting there with no occupant.
Vacant.
Now, because the crisis was so bad, and the federal government stepped in and started doing all sorts of things to stabilize the market and reassure people, what happened en masse instead with all the subsidies that happened was there were a lot of vacant homes, and there were a lot of neighborhoods that were basically wiped out. So your house, against which there is a mortgage floating around, that house may have been have frozen pipes because no one's watching it. It may have been vandalized because somebody wanted to go in and steal the metal, the copper, or the furnace.
For squatters.
For squatters, things like that. Or it's just sitting there and eventually the roof deteriorates and it starts to leak. And the house is so far away from where you live, and there isn't really anything that you can do other than either pay someone to go and inspect it. You can get a real estate agent to do a drive-by and give you an estimated drive-by value, or even do a full appraisal. But if you're going to pay money to do that, then the investment value is going down. So that's something else because you've got a little bit of an expense there.
Well, and people who generally do this aren't somebody that they can just go to the bank and get the best rate. They might have issues with their own credit. So the people that you're offering this to might not be, they might be, let's say, self-employed, or they have a very, very erratic kind of income that's coming in. So,
and remember, these things are mortgages, so they've been written by a bank at some time in the past. So what's happened is you've got all these mortgages that don't pay, and the banks want to unload them because they're not in the real estate management business. They're banks.
But they're also in the making money business. So as an independent investor, I also want to make money. So really, you have to do your research and really have to see who that person is. And if it is with a very just one person that you're lending this money to, you have to do your research on that person and see what they're like. Right. What kind of income they can, and if they're good or not good with their money too. That ultimately, I think, is the big kick in the pants.
Yeah.
That person is not financially savvy, or they're in trouble already, or they have a past of trouble.
Yeah.
So
well, in my case, again, it was one of those things where the character of the fellow that I was dealing with, he's very good, very honest guy, but he's also human. And what happened in one of the notes that I invested in, I put in money and bought the note, and it took a long time to work it out. It took a long time to track down the original mortgagee, and he was very honest about it. And then, as it turned out, sort of through the wash, we got a lot of money back out of it and kind of broke even. Didn't make a profit, but as it turns out, the actual house was in a neighborhood in a city in the U.S. that the neighborhood was becoming, it was kind of like Detroit. It's starting to become vacant land again after many years. So the value of the house itself was falling to zero, And if you inspected the house, and someone did go inside at some point on his behalf, took a look inside and found that one of the walls had a big bend in it. So that meant that water had penetrated the house and the walls were starting to collapse. And if you look around in the neighborhood, it was really one of those places where you needed a billionaire to come in and buy the whole, 100 acres around you and put in, just redevelop the whole area.
Right.
And then because of other things going on in the economy, the industrial base in that area that established the neighborhood in the first place was gone, right? So the whole structure of the neighborhood and the city were in flux and changing. But as it is, you've got the mortgage on the property, so you have the potential to take over the title.
Right.
And down the road, there might still be profit in it, but you're going to probably have to wait a long time, for it to turn around.
So this is like anything can happen in real estate, and this is one of the things that if you're becoming an investor, you need to understand what is the risk and be okay with it.
Yeah.
And the best way to do is, first of all, know your financial position. I always tell people, know your financial position, because that, if you're strong, then if something happens or you have to wait for your money for a long time, then you're not strapped, like waiting for that money.
Right. And I think we all agree on that whenever I think that's the way with you two, for sure. For me, I don't put all my eggs in one basket. I have multiple investments in multiple different ways, not just real estate, but obviously, we all don't have a crystal ball, especially during COVID, when investing means different things, and time frame might be different, because if we invest in something, let's say even home improvement, with all of the costs rising for even lumber, something like that, we might not see a return if we decide to do a flip or something as much as we were expecting a few years ago. So the market's gone up too. So you don't know. Everything fluctuates. Everything, you really have to have, we always say plan B and a plan C.
Yeah, that's right.
And also diversify, right, Araceli?
Yeah, absolutely. So that it starts from knowing your financial position, and then go from there. And usually real estate investing, especially with certain things like mortgage notes that are not well known and they're complicated, that if something could go really wrong, you just have to be very careful on what you pick, how you do it, and so on. You
have to take responsibility and educate yourself.
And know your risk.
You have to know your risk. It's in a perfect world. I mean, let's say tomorrow I won a $4 million lottery. Well, I would put some of the money in various real estate investments, but I wouldn't put all of it in there.
Yeah.
I would also invest in maybe some training courses for myself on various topics. And I would also put some money aside somehow for my kids. And I would break things up into different portfolios of different kinds of things to spread the risk. Because what I've learned is the best intentions still can be thrown on the rocks, and you can get a hole in the boat and draw on water and not get out of the storm for a long time, right?
Absolutely, yeah.
And you have to grow a thick skin. We learned that down in the States, Araceli.
Absolutely. And we're gonna have another whole chat about that for sure.
Yeah. So there's a lot to be said for living, what I call living close to the ground, in the sense of you might be wealthy either on paper or otherwise, but you've got to have a time horizon that's long. It's like 20, 30 years.
Of course.
And if you're going to jump around and try some speculative things, when you do that, you don't allocate a lot of funds to that sort of stuff. And you start small, and you start with some form of self-education. And that might even be free. There's a lot of free stuff out there.
Well, the information
that example, right?
We give lots of information too, just on the show, for people who want to get started in real estate and different ways that they can get it. So that's why we wanted to talk to you, because this was another way of looking at an investment, another option. If you don't want to be a landlord, I get that question quite often, where they're like, I have all this money, but I don't know where I want to put it. I know I want to put it in real estate, but how do I get started? And if I don't want to be a landlord, how do I do it? So this is an excellent option. So thank you very much, Tim.
Well, thank you, Tim, for coming. And really, this is to educate people, just to make them aware of what's out there, other ways to invest in real estate. May or may not be for you, but just be aware that this is available, and just do your due diligence and research.
And get a lawyer!
Yeah.
Well, yeah, but even then, there's a time for a lawyer and there's a time for you to be your own lawyer.
Absolutely, but it's also your risk. So that's the one thing I do want to say. We did say it, but if you're risking your residential home that you live in to get an investment, some people say don't do it, don't risk it. Araceli's shaking her head. So this is the thing: you have to outweigh the risk versus your lifestyle, and if it's not right for you, then there might be something else that makes more sense.
Absolutely.
So we're here to answer. We're here to answer all your questions. So don't ever hesitate. Leave a note. Leave a little message for us, and we will answer your questions for sure.
Yeah. Just remember that all investing is for the long term, and we usually kind of give you about 7 to more years, minimum 7, I would think that is the minimum. And if you cannot have the funds tied up for that long, then that might not be for you. But you have to think about start slow, start small, and continue to move on. Well, thank you so much, Tim. Really appreciate you being here on the show. Thank you, Colette. And this is awesome. So you guys, if you have any questions, please let us know. Please comment and keep the questions coming.
And thank you for joining us today, too.
Thank you very much.
Thank you, Tim. And we'll see you next week.
Thanks for joining us today. If you'd like more information or if you have any questions, please go to my website at www.coletterabba.com.